Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing ONEOK stock so we can determine if it's a buy or a sell. ONEOK's focus is on natural gas. It also owns natural gas liquid systems from the 2005 acquisition of Koch Industries. The original name of the company was Oklahoma Natural Gas Company, but they changed their name in 1980 to ONEOK. The company is headquartered in Tulsa, Oklahoma, and was founded in 1906. Let's get started with the model. This is a large cap company, 26 billion market cap. They're trading at $59 a share, and they have 448 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They did have negative free cash flow in 2019 and 2020, a really big negative in 2019. But they did have positive net income, so it does indicate they invested a lot into CapEx. Cash flow became positive in 2021 at 1.8 billion, dropping a little to 1.7 billion in 2022. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's 1.3 billion in 2019, cut in half in 2020 to 600 million, then passed the 2019 number to 1.5 billion, up again in 2022 at 1.7 billion. Revenue is the sales for the company, and that was 10 billion in 2019. Their revenue came down in 2020 due to COVID and low oil prices. It was 8.5 billion. It nearly doubled in 2021 to 16.5 billion. Then grew a lot into 2022 at over 22 billion. They recently released their first quarter earnings, and in the first quarter of 2023, revenue of 4.5 billion, down from 5.5 billion in the same time period in 2022. Let me show you a breakdown of the 4.5 billion. They had the most revenue in NGL, natural gas liquids and condensate, 3.6 billion. Residue natural gas sales, 600 million. Residue is what's remaining after the separation process. Gathering, processing, and exchange service revenue, 169 million. Transportation and storage, 193 million. And then other, 5 million. It cost them 3.3 billion to buy the fuel, 239 million in operations and maintenance, 160 million in depreciation and amortization, general taxes, 57 million. They had a gain on other, 781 million. I'll show you what that is. There was a fire in July 2022. It was in Oklahoma at their natural gas liquids fractionation facility. Fractionation is a separation process. It's how they're able to convert the raw material into things like ethane and butane. The rest of this article talks about the insurance process. They recorded a gain of 779 million from insurance proceeds. So they have to report that onto their income statement. So that's why they had really high operating income in the first quarter, due to this insurance gain. Operating income of 1.5 billion, up from 660 million. They had a $40 million gain in equity investments. I'll talk more about their equity investments when we get to the statement of cash flows. But this is going to be reversed out on the statement of cash flows, the 40 million. They spent 166 million of interest, similar to last year. 330 million of taxes, a lot more than last year. So their net income was a little over 1 billion. Last year was about 400 million. Their EPS was 234. Last year was 87 cents. And they added 1 million shares from last year to this year. They have 448 million shares outstanding. This is the operating section on their statement of cash flows. And you could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. The way we calculate CFO, we start with the net income, then we have to add or subtract the non-cash items on the income statement. We add back depreciation and amortization. We have to minus out the gain in equity investments, but they received 43 million of dividends from those equity investments, so we add it here. I'll show you what these investments are. Here's a breakdown of the 40 million of equity investments. 24 million in Northern Border, 9 million in Overland Pass, and 7 million in Roadrunner. Northern Border is a natural gas pipeline which brings gas from Canada through Montana, North Dakota, South Dakota, Minnesota, and Iowa. All of that into the Chicago area. So this pipeline is owned by ONEOK and the Canadian company TC. The Overland Pass Pipeline is a joint venture between ONEOK and Williams. And this project transports 245,000 barrels per day of natural gas liquids. Roadrunner is a 200-mile natural gas export pipeline. Firmica and ONEOK each own 50% of this. Regarding the fire with the Medford insurance proceeds, they actually received $500 million of cash. Their accounting profit was $779 million. The accounting profit has to be subtracted out, and the amount of cash has to be added to the CFO section. Because the purpose of operating cash flow is to convert the accounting profit into cash. And then we have to adjust for changes in working capital. It looks like they extended credit in the past and received $329 million of receivables. Last year, for instance, they extended credit of $244 million. That means they sold a product or service but didn't receive cash for it. The customer bought on credit. They had a cash outflow of $237 million in accounts payable. So they used accounts payable in the past, maybe last year, and they're paying for it this quarter. Even though their accounting profit was $1 billion, they actually generated $1.2 billion of cash flow. Let's look at the capital structure. $6.5 billion of equity, $14 billion of debt. They're 32% equity, 68% debt. Their net debt is $13.5 billion. So they have $220 million of cash on their balance sheet. I gave them a WACC of 10%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $32 billion. We discounted those numbers back to today using a weighted average cost of capital. We get a value of the company of $29 billion. We divide that by 448 million shares. And we get a calculated stock price of $65. They're trading at $58, so they're trading at a 10% discount. It's a buy according to the model. Simply, Wall Street's valuation is 86. They say the stock is 33% undervalued. 14 analysts priced this stock, and the average price target is 72. The low is 57, the high is 81. 17 analysts priced this stock, and the average price target is 70. They say it's 21% undervalued. This is where the stock has been trading since 1995. From 95 to 2007, the stock steadily rose. Then the Great Recession occurred, and oil did crash around this time. So that's why the stock came down a lot to around $9, $10. Like most oil stocks over the next 5 years, it really ran up. This went past $70. And then oil took a real big crash in 2015, 2016, and the stock came down to about $19. Then another bull run, the stock went up over 300%, hitting close to $80. Then when COVID hit, it crashed again down to $20, but it came up a ton since COVID. It broke through $70 recently. It's trading around $60 today. It's so crazy how fast the stock drops, but it could take many months, sometimes years, to get back up to where it was before the drop. That's why bear markets are much shorter than bull markets. They pay a quarterly dividend. It's currently 96 cents a share, a yield of 6.5%, which is ironically 100% of their free cash flow, 99% of their net income. There are 52 companies in the same industry as ONEOK, and if ONEOK has a number in red, they're worse than the median. If they have a number in blue, they're better than the median. They spend more than the average in CapEx. They have a better debt-to-equity ratio than the average, but worse than the median. For every dollar of equity, they have $2.10 of debt. Their yield is between the median and average. They generate a good amount of free cash flow. They're ranked 10th in market cap. Their price to book, PE, and price to free cash flow are all worse than the median. But their price to book is better than the average. They have a really good price to sales ratio, much better than the median and average. They generate lots of revenue. Their 5-year annual revenue growth rate is only 11%. The average is 16%. So to summarize, I have them trading at a 10% discount. They've been around 117 years, and their numbers look really great in 2021 and 2022. But as we saw earlier, the stock is really volatile. If you pick it at the wrong time, you could wait decades to get your money back. I ranked their free cash flow 6 out of 10, their revenue 8 out of 10, and their ratio is 4 to 10. So let me know what you think. Give the video a like, subscribe, or comment below. If you want to be a member, click on the link in the description below. Thanks for watching.